Good afternoon, everybody, and welcome back to my YouTube channel. Today, I'm going to be taking you through a fun fact sheet, basically how to read it. So I've chosen Prescient. I'm a little biased because that's where my money is, but it's also where I used to work. So I'm familiar with the fact sheets and how to navigate the website. So all I did is I started here and I googled Prescient. I googled Prescient and then I clicked on www.prescient.co.za, right? And they've got a nice site. So that's the slogan: far-sighted, reliable, and precise, which speaks to the name, which is Prescient. And you can invest with us online, etc., etc. But I'm not going to take you through that. What I'm going to be taking you through is the actual funds, right? So I'm going to take you through, there's different asset classes depending on your risk appetite, etc., which is something that I'll touch on now. But you've got multi-asset, you've got equity funds, you've got interest-bearing, tax-efficient, rand-denominated offshore funds, tax-free savings, you've got offshore, you've got other, you've got unit prices. So the unit prices aren't a type of fund, it's the unit prices for the funds that you can just look up. You've got third party or white labeled funds, you've got foreign approved third party, and then you've got phase advisor accreditation, right? So that's also not a type of fund. That is basically telling you that they are, an accredited institution to be, showing or giving financial advice, right? So what I'm going to be doing is I'm going to take you through the multi-asset. So as you can see from the name, multi-asset, multiple asset classes that the fund can, not go through rather, but that the fund can invest in. So I'm going to click on the fact sheet, and that's basically what we're looking at. So let me kill this. It's the exact same tab. Right. Okay. So I'm taking you through the Prescient Income Provider Fund. So the A2 is just the I want to say the class, the investor class. So when you're a staff member, you're in B3. When you're institutional, it's A2. When you retail investor, then it's A2. And then you also get institutional. So institutional is like Telkom Retirement Fund, Eskom Retirement Fund. So they would have a different asset class, right? But me and you, we would fall under A2 because that's basically the retail class. So we are retail investors, right? Okay, so this is the minimum disclosure document, which is MDD, but it's also the fund fact sheet, right? So this is the latest one as at 30th of November 2022. So we'll see performance, monthly performance, annual, and you'll see how long the fund has been running, which is also quite important. You'll see the benchmark, so basically what it's measuring against, what your expectations are in terms of what it's getting, in terms of returns, as we'll also go through a bit of the glossary at the end, right? Which is quite important. So about the fund, so the fund manages the Prescient interest-bearing team, right? So if you go back to Prescient, you can actually see the team. Who are we? It's not the directors. Let me see, funds. Okay, I don't know where you can look at the team. Okay, so here's the team, right? So you've got Guy Toms, which is the strategist and co-founder. You've got Henk Kotze, which is head of income and cash. You've got Muresh, who is a PM. You've got Jabu, he's a good friend of mine. Jabu is a PM, also an analyst. You've got Ishmael, I used to work with him as well. And then you've got Bastian, who used to be my boss at when I did my stint at Prescient, right? So they are the team that the fund fact sheet is referring to. They are the Prescient interest-bearing team, right? So the fund classification is the South African multi-asset income. So why is this important? The classification is important because if you want to compare the Prescient Income Provider Fund to the Allan Gray Income Provider Fund to the Coronation Income Provider Fund, you need to be comparing like for like, right? Because Prescient is saying that it's multi-asset, then you can't go and compare it to something that has a different classification because the rules for that fund and what it's allowed to invest in is different to this. So that's just the importance of the fund classification. We're not going to be comparing to other platforms and other asset managers at the moment, but it's just something to keep at the back of your mind. Benchmark is Steffi Core. 1.1 or 110, so 1.1 times the Steffi. So the Steffi is the short-term, we can just Google that. It's short-term money market though. It's a nice benchmark. So it's Steffi index, Short-term Stiffy Plus. Yeah, basically Stiffy benchmark, it's basically short-term money market, um, short-term and fixed income money market index, right? That a lot of the money market or cash funds use to benchmark against. So that's also very important when you're trying to compare. So we saw a momentum one. I know Coronation also has one, and I know Ellen Gray definitely has a cash or money market fund. So you would look at the fund classification and the benchmark to see if you're comparing like for like between asset managers, right? They've got the JSE code. So if you've got access to Bloomberg, this is the code that you would use if you wanted to look at the returns month on month, year on year, and all of that, even the daily, right? The Eisen code for this instrument also on Bloomberg. Fund size 34.6 billion. So fund size is quite important because what it's basically telling you is you're going in there with your 10,000 Rand and then there's 34.6 billion already in the fund. So it's basically showing you that it's a established fund and you've got big retail investors in there and you've got massive institutional investors also within the fund. So your 10,000 Rand is safe basically. But if you were to look at this fund size and it's 100,000, you going in there with 10,000, that's basically 10% of, the fund. So that's what you can read the fund size as. Number of units also just speaks to the fund size. Unit price, so it's basically saying at the 30th of November, each unit was worth 142 cents, right? So it says there's cents per unit, 142 cents per unit, if I'm reading that correctly. I don't know if it's, yeah, I think it is cents. So that would be 142 cents per unit, right? Okay, and then you've got the inception date. So this fund is a long track record. 31st December 2005. What is that? 17 years. So that's a solid track record. That together with fund size would give you, you'd feel good because you're thinking, okay, other people have invested and it's been standing steady since 2005. So me putting in my 10,000 Rand there, my money's still going to be there, at the end of the month. So it's just a trust factor more than anything. Okay, so you've heard me speaking about 10,000. Why am I speaking about 10,000? Because for this particular fund, the minimum lump sum is 10K, right? But if you don't have 10K, or what you can do is you can set up a debit order on Prescient online. And what you can basically do is just contribute 1,000 Rand per month towards this fund. So that's just something to be mindful of. That's where the 10,000 amount is getting from. Well, that's where I'm getting the 10,000 Rand from in my examples. There's no initiation fee, and then you've got an annual management fee of 0.5. So you don't have to do the math there, because when you get your fact sheet and when you get your transaction note, when the debit order goes off monthly, they will send you the returns after the fees have taken off, after the monthly fees are taken off. So it's an annual management fee, but monthly when they show you the returns, it's after they've taken out the management fees for the month, right? There's the fee breakdown. You're basically paying 0.5, no performance fees, other fees about 0.10. So that's what they pay to the Manco, which is Prescient Administrator. So those are the people you're more likely to deal with. That's the company that if you're sending in your documents, your FICA, they would be dealing with it. They're the administrators, and the investment team is Prescient Investment Management. So they're the ones that would get that 0.10. You see this here, which say includes underlying fee, audit, custody, trustee fees, and VAT. So that's basically what they will be paying PFS, which is Prescient Fund Services. And then the 0.5 would go to the team that I just showed you, which is the investment team, right? Okay, so these are the income distributions that you get. Like I said, it's an income fund, so they pay distributions. I think quarterly. I stand corrected on that, but yes, I think the income distribution is quarterly, which is quite useful, right? Okay, let's get into it now. Investment and return objective. So the fund aims to return CPI plus 3% per annum through a full interest rate cycle while providing stability by aiming never to lose capital over any rolling 3-month period. Okay, so I'll touch on what CPI is, and then I'll touch on what the rolling 3-month period is. So, sorry, my mouse is acting up, so I'm having trouble scrolling. But what CPI is, and I've opened up this already. So CPI is basically the basket of goods in South Africa and how much they cost and how much they've gone up month on month. So here we're basically saying annual consumer price inflation was 7.5 in September, down from 7.6 in August. The CPI index increased by 0.1% month on month. The main contributors to the 7.5 were food and non-alcoholic beverages, housing and utilities, transport and miscellaneous goods and services. So it's basically saying month on month, how much did things go up by? Food and non-alcoholic beverages increased by 12 or 11.9% and contributed 2 percentage points to the total CPI of 7.5. Housing and utilities increased by that much and contributed that much. Transport increased by 17. Oh, that's crazy. But that's because of the petrol price, right? And then miscellaneous goods and services, which is basically other, increased by 4% year on year and contributed 0.6. And then in September, the annual inflation for goods was 10.7, down from 10.9. And for its services, it was 4.3 and change, right? So that's basically what CPI is. It's a basket of goods that they look at. They try and look at, a variety of goods that typical households in South Africa consume. So meal, some fruit, some veggies, bread, flour, oil, or cooking oil. And they try and combine them, and they see in August, this basket of goods cost 2,000. In September, this basket cost 2,100. Therefore, it went up by 100 Rand, and then 100 divided by 2,000. So that's basically what CPI is. So what this measure is trying to do is it's basically saying, this fund is basically saying, if you put in your money, right, our aim annually is to give you CPI plus 3%. Why is that important, right? So if I'm investing and let's say I put in 10,000 now and I want to take it out next year, right? When I take it out next year, I want that 10,000 to buy the same number of loaves as it was able to buy today. Otherwise, I might as well put, my money under my mattress, like who. So what CPI tries to do is it tries to see if a loaf of bread was 20 Rand today. If next year the same loaf is 25 Rand, my money must also grow so that I can buy the same number of loaves of bread. Do you understand? So this fund is basically not just giving you CPI flat, but CPI plus 3%. So above CPI. So it's important for me and you, but it's also extremely important for people in retirement, right? Because they get a lump sum, right? So when they get their money in a lump sum, the portion that they get in a lump sum, they typically also buy an annuity with it. When they buy the annuity, they don't want, because they don't have other means of gaining, income, right? And getting those annual CPI increments at work. What they typically need is sort of a way of knowing that, look, the baseline is I'm always going to be able to afford my bread. I'm always going to be able to afford petrol if they still drive at that age. I'm always going to be able to afford housing. So CPI plus 3% is basically saying they can keep their lifestyle as is. They're going to be able to afford what they were affording when they were working to now that they've retired. So you can think of CPI as a measure like that. It's basically, can I buy the same amount of bread? Can I buy the same amount of petrol? Can I buy the same amount of housing? You understand what I mean? Think of CPI like that. It's like this year versus last year versus the year before. How much were the things that I was buying already? You understand what I mean? I don't want to have to change brands. I don't want to have to change where I live. I don't want to have to change my car for petrol usage and all of that. Okay, so I'm going to move on with that. Okay, and then the rolling 3 month is basically saying we're in December now. So December, November, October, that would be a rolling 3 month. And then it's basically a window, right? So a moving window. If you want to think of, I'm thinking moving averages now, but it's basically a window. So it's Jan, Feb, March. And then when we move again, it will be Feb, March, April. We move again, it will be March, April, May. So that's what a rolling 3 month means. It means the previous 2 months, including the month we're in. The investment process, this fund invests in local and offshore money market, bonds, property, preference shares, inflation-linked bonds, and derivatives to meet the investment objectives. Fund performance can be generated from taking interest rate views on curation, yield enhancement via credit instruments, asset allocation between income-producing asset classes, offshore exposure, and also via the use of derivatives. So that's basically why it's called a multi-asset, fund, because it invests in multiple asset classes. So that's all that we're saying. Who should invest? Investors seeking stable real returns and aiming to maximize income via exposure to primarily the South African money market and bond markets. The fund is suitable to investors with a short to medium term investment horizon and is Reg 28 compliant. So this is very important, the time frame, right? So I've got money in income provider, right? So my income provider money isn't in my tax-free because I don't want to withdraw from my tax-free unless I have to, right? So it's in my separate investment vehicle, right? Just my regular unit trust, right? And if I want to withdraw something like 10,000 Rand that I put in 3 months ago, I can do that without the unit price changing too much. Do you understand? Whereas with equities, I can put in 10,000 today, and then next week something happens to Naspers, something happens to, you know, what is this? British Tobacco, all of the big ones, and let's say I'm invested in the top 40, and then my 10,000 turns to 6,000 Rand, right? So I'm going to be less able to withdraw that money in a week's time. So equities require someone with a medium to, let's say, long-term investment horizon, whereas for cash or money market or income provider, if I put in 10,000 next week, if I want to take out the money, I can probably take it out as 9,000, 400 if something really bad happens, but it's more likely 10,000 and 9,900 or 11, or 10,100, 10,200. So it doesn't grow too much. At the same time, it doesn't go down too much. So that's why the term is low. Plus, they told you here that the key is to never lose capital over any rolling 3 months. So if I'm taking out my money next week, I don't expect it to have gone down a lot, but I also don't expect it to have increased. So I'm not going to put in 10,000 today on this fund, and then next week it's 11,000. That's really going to happen. You understand? Because like they said, CPI plus 3%, we saw that CPI is at 7.5. So 7.5 plus 3, that's about 10.5%. Again, CPI changes, right? CPI changes monthly. So it's not always going to be at 7.5. Sometimes it goes low, sometimes it goes a bit high. So this CPI plus, it doesn't mean that next month you automatically going to get 11% worth of returns. And we're going to see more of that, the historical return profile of the fund a bit lower on. But basically it's saying it's short to medium term. If you want the money in the next year, if you want the money in the next 2 years, typically what I do is I put in money throughout the year, right? I put in my tax-free and I put in my unit trust. And then if I need something, I will take out money out of the income provider portion of the unit trust, right? Because it's liquid. That's basically my most liquid investment, right? Okay, so it's also the kind of fund where would you want to put in your, emergency savings if you have something like that going on, because your capital doesn't diminish, quickly over the short term. So it's designed to preserve capital. You understand what I mean? It's not going to double in income. You're not going to make millions off of this fund, but that's not the aim. Right? The aim isn't to make millions off of this fund. The aim is to preserve capital. That's something that we have to be mindful of. Okay, and then the risk indicator definition. So these portfolios typically have no or low equity exposure. That's what I spoke about British Tobacco and Naspers, resulting in a higher interest rate yields and stable capital values with the profitability of capital losses of the short term, 3 months, highly unlikely. Not impossible, just highly unlikely. These portfolios typically target regions in the range of 1 to 3% above inflation before tax over the long term. So what that's basically telling me is inflation is, I think we've touched on this in a previous video, but inflation is basically how much my bread can buy today versus next year versus the year before or the following year, and versus historically. It's like when we're chatting to our parents and they're like, bread used to cost 5 Rand, right? Their salaries also were not as much as we're earning now, but they were commensurate with that point in time. So what this is basically saying is they try to get at least inflation or inflation plus, which is similar to what the CPI is trying to do. So inflation and CPI also just basically tell you the cost of living, the cost of goods. So this fund would basically tell you, look, you can still go to Engine for your petrol. You can still buy the same bread. You don't have to switch groceries. You can, if you shop at Pick and Pay, you can still shop at Pick and Pay, because we're gonna target returns in the region of 1 to 3% above inflation before tax over the long term, right? Okay, so risk indicator, like I said, they're in the conservative portion of things. So you're not going to make millions, but at the same time, your capital is still going to be there, right? So year to date, relative to the benchmark, remember we said the benchmark was the STEFI core at 1.1 or 1.1 times Steffi core. So year to date, it's been outperforming, the benchmark. So same thing on the 1 year, 3 year, 5 year, 10 years since inception. So it's basically saying you're making more money out of investing in this fund relative to if you were to just go and buy the ETF, which is the Steffi Core 1.1, right? So that's, good to know. Otherwise, why am I paying 50 bips to the team? So this is also just cumulative performance over the years. You can see there's an upward trajectory, which is always good to see. And then you've got annualized performance, 1 year. So the fund is done about 6.59%. 3 years, 6.13, 5 years, 7.16. So you can't look at this and say that it's lower than CPI because CPI last month was 7.5%, because you don't know what CPI was the previous months. So that's just something to be mindful of. It's not just a one-to-one, because here we're looking at monthly CPI, whereas here we're looking at an annualized performance number. Over 10 years, we've done about 8.28%. So inflation is typically is it 6.5? 6.5 is quite high now. It's typically below, it's typically between 3 and 6%. So let's say 4.5 is the midpoint. But recently it's been on the higher end of the band, about 6 something. So what this is basically saying is 1, 3, 5, 10, and since inception, you're doing better than inflation if you put your money in there, which is always good. And then you've got your highest rolling 1 year, and then you've got your lowest rolling 1 year. I think I explained the rolling, right? So you just move the years. So it's not necessarily Jan to the following Jan. It's moving. It's a window. It's a moving window. But it's basically 12 months like we think of it. And then the lowest is 4.4. So the highest rolling is higher than the benchmark. The lowest rolling is higher than the benchmark. That's good because it means even in the toughest of times, we still managed to beat the benchmark, right? And that was probably 4%. That's about CPI mid-band, right? So you wouldn't have lost too much capital. You wouldn't have, had to move from shopping at, Woolies to, whatever you deem is lesser than Woolies. You could have kept your lifestyle still. You wouldn't have had to borrow money or do anything drastic to your lifestyle, even in the worst of times, which is quite important to look at, because this is great, but I also want to see, because they say that they preserve capital, how well does this fund do in tough times? And this is basically what this number at the bottom is telling me, right? Okay, risk and fund statistics since inception per annum. Forward yield gross is about 9.56%. That's always good. An alpha of 1.97%. So alpha is basically how much it beat the benchmark by. So it's above the benchmark by about 2%. Sharp ratio tells you the risk per unit of return. Standard deviation from the benchmark, that's basically what it's also telling you. Percentage of positive months, so it's been in the positive for about 93% of the months, and then average duration 1.59. So what that basically means is average duration speaks to the instruments that it holds. It's basically saying that the fund team typically holds instruments that are 2 years in duration. So this is important because what it's basically telling you is when push comes to shove, how easy is it for this team? And I showed you the team, right? How easy is it for this team to liquidate the assets, right? If these guys are holding Eskom bonds with 30 years, if they are holding, R2044, if they are holding extremely illiquid bonds, right? It means it's going to be heavy for them to liquidate and to get out, right? So what it's basically saying is these guys aren't holding any of that. They're not holding your long end bonds for Transnet, your long end Eskom, all of those, SOE bonds at the far end. They're holding more liquid stuff. And if they are holding, the ones with a nice credit spread at the end of the bond curve, they're holding that in very small proportion relative to the more liquid stuff. I'm thinking things like step-up notes, so things that roll every 3 months. You can get maybe a 6-month note, maybe a 12-month, money market note. So those are the typical things that you're looking at for a fund like this. So it's basically saying if things go wrong, it's going to be very easy for them to get out of it and get cash. So think of it like that. So average duration is basically of the instruments, how long does it take for them to typically mature? So 1.5 years, what is that? 18 months. That's a really good time for a fund like this. And bear in mind, they've got 34 billion. So it's very rare that everyone is going to come knocking on their door, right? But you also want to know, like if your 10,000 is there, you want to know how easy is it in tough times for this fund to get out and to give me my money? Because at the end of the day, that's what you're interested in, right? Okay, so fund commentary. So they basically say for November 2022, after local inflation eased slightly in September, the October print came in higher at 7.6. We saw that, right? The CPI. With inflation still above the target range, so the target is about 3 to 6%, the SARB elected to hike interest rates by a further 0.75 in November, making it the 7th consecutive meeting to see monetary policy tightening. The US experienced another reprieve in inflation as it slowed to 7.7 in October, the lowest print since Jan. This may assist in the Fed's hopes to scale back the pace of interest rate hikes in the months to follow. We'll continue to look to add to our duration in the fund where our risk budget allows, as the curve still shows value. We have seen the fund yield move higher during the month as the MPC moved rate. So what they're basically doing here is they're explaining the economic environment. What they're doing here is they're basically comparing it to the US markets, because when America sneezes, the whole world catches the flu. So here we're basically saying we see the fund in favorable position given the attractive yield built into the fund, given the risk-first signature we have maintained. And then on performance, they say November was a strong month for the fund, mostly driven by the fixed rate bond exposure in the fund, as we saw yields moving lower across the curve. We saw contributions from most of the asset classes, with only preference shares detracting. The 12-month forward yield increased to 9.56, with the fund duration close to our target of 1.59, in line with our risk budget. The fund is well positioned to protect capital in these uncertain times, and at the same time delivering a yield superior to most other interest-bearing solutions. That's always comforting to hear, right? So they're happy with their performance. You want them to be. They've got your money, right? If they're happy, you're happy. Prescient income provider fund, right? So you've got, this is basically what their holdings are. Think of them as their holdings, right? So you've got real estate, which is a very small portion. You've got fixed rate bonds with the duration of 1 to 3 years of 0.7. You've got fixed rate bonds of 7+ years at 18%. So they are holding quite a bit of that, right? And then you've got cash and money market at about 14%, reasonable. You've got some offshore, holdings of 13.8, floating rate bonds of about 6%. You've got fixed rate also here. You've got credit linked CLNs of different maturity. You've got ILBs over there. You've got preference shares, the ones that they said detracted from the performance. So you see that there aren't any equities here, right? The riskiest you could go is probably the real estate, which is very small. So that's why it was saying that they've got a risk budget. So they've carefully, curated, the fund composition to reflect what they said at the beginning, right? Because this is a minimum disclosure document. They're not going to promise something and then the fund composition doesn't reflect that, right? So you've got heavy holdings of cash and money market. You've got fixed bonds. A lot of that are SOEs and your banks, which are credible. So the returns aren't great, but how often do banks default, right? So that's what you're basically seeing over here, which is basically speaking to the capital preservation, which they promised at the very beginning. And then these are the fund monthly returns. So I'm interested in 2008. I don't know if my mouse is going to highlight. I'm interested in 2008 because that was the global financial crisis. So Jan, they didn't do well. Feb, March, April, that's when things dipped. They sort of recovered. Year to date, 2008, they did very well at 14.19, right? Why? Because derivatives and equities didn't do well. So a cash or an income fund is what you wanted in a time of crisis, right? Same as 2020, that's what you were looking for, right? Another financial crisis. So cash was king at that time. So you'll see in March, which is when the brunt of things, happened. The fund dipped at about 2.84%. They recovered in April because they have a short duration. They were able to let go of all of the troublesome, holdings, and they were able to go back to possibly increasing their cash and money market holdings because of the uncertainty. Cash was king, as is always the case, in times of distress. And then they did 5.29% at the end of the year, which actually isn't too bad. And then we'll go to 2022, so 0.3 in Jan, Feb, March, April, so it's actually not looking bad. September, they had a bit of a bad month. October recovered. November, they did very well. So November was actually the best month this year. So year to date, November was the best, and they're working on 5.39 for the year. We're just waiting on the December print to see what that looks like in totality, right? But they've already beat 2020, so they're getting back. And unless this is flat, this number is looking to be about 6.5 as well, which is looking good, right? Right, so I'm going to take you through the glossary at the end so that we have a better understanding of everything that was explained in here. And then I'm going to close off the video. And then this is the Prescient Income Provider Fund. You can chat to me about any other funds, fact sheets that you'd like me to look at, what you understood, what you didn't understand, and yeah. Okay, so annualized performance shows longer term performance rescaled to a year period. Annualized performance is average return per year over the period. Actual annual figures are available to the investor on request. Highest and lowest for any 1 year since inception have been shown. NAV is the net asset value, which represents the assets in a fund less its liabilities. So what that basically is daily, Prescient Fund Services will send PIM, which is Prescient Investments, a weighted average value of the fund based on if they hold 10 cent and let's say they hold 2 10-cent shares and they hold one MTN bond. What they'll do is they'll price the bond and then they'll price the shares, and then they'll say 2 times the price of 10 cent, 1 times the price of the MTN bond, and then they'll weight that, and then they'll tell you the fund is worth 30 billion today, and then tomorrow it's worth 31 billion. So that's basically the net asset value. The NAV is also what you saw here as the 34 billion, right? That's the fund size. That's a net asset value, right? Where am I? You've got current yield, which is actual income, which is interest or dividends divided by the current price of the security. Okay. And then you've got cents per unit. You've got alpha, the outperformance of the fund. I already spoke to that. Sharpe ratio indicates the excess return the portfolio delivers over the risk-free per unit rate adopted by the fund. So think of the Sharpe ratio in layman's term as how much return I'm getting per unit of risk. The deviation of the return relative to its own average. Okay, we've got positive month. Percentage of positive months since inception of the fund has delivered a positive return. So you want this positive to be high. You want the Sharpe ratio to be high because it's excess return, and then you want standard deviation to be low. Standard deviation is basically saying, I don't want the fund to change amounts. If I have 100 Rand today, tomorrow I don't want it to be 200, and then the next day I want it to be 50 Rand. I want it to be 100 Rand today, 101 tomorrow, maybe 99 the next. So that's what the standard deviation is. So you want that to be very low. You don't want it to deviate from its core price because of the nature of this fund. Average duration is the weighted average duration of all the underlying interest-bearing instruments in the fund. Forward yield is the expected combined income of the instruments in the portfolio over the next year, expressed as a percentage of the current value of those instruments, right? So it's predicted, right? Like they said here, it's over the next year, forward. Okay, fund-specific risks. So there's default risk, which is the risk that the issuers of fixed income securities, ESCOM, may not be able to meet interest payments nor repay the money they have borrowed. The issuer's credit quality is vital. The worse the credit quality, the greater the risk of default and therefore investment loss. There's some derivative risk. The use of derivatives could increase overall risk by magnifying the effect of both gains and losses in a fund. As such, large changes in value and potential large financial losses could result. So in a fund like this is where you're typically seeing derivatives. So it's that offshore hedged to ZAR, right? They'll do some, cool stuff over there. And then you've also got foreign investment risk, which is foreign securities investments may be subject to risk pertaining to overseas jurisdictions and markets, including but not limited to local liquidity. So that could be a foreign exchange, macroeconomic, political, tax, settlement risks, and currency fluctuations. This is also why you'll see that they spoke in the commentary about what's happening in America. It's also why you'll see a lot of the commentary on the equities funds will speak about what was happening in China and what was happening with the Ukraine and Russia war, because obviously those are political, it's macroeconomic, it speaks to, currency fluctuations and all of that. And it can also speak to, liquidity when you're trying to sell out of those instruments. So that's why it's important, because financial markets are, interrelated. You've also got interest rate risk, which is the value of fixed income investments, each bonds, which tends to be inversely related to interest and inflation rates. Hence, their value decreases when interest rates and or inflation rises. So inflation has been on the rise and interest rates have been on the rise, which means that bond prices have gone down. So that's the interest rate risk that we're speaking about here. Property risk. Investments in real estate securities can carry the same risk as investing directly in real estate itself. Real estate prices move in response to a variety of factors, including local, regional, and national economic and political conditions, interest rates, and tax considerations. I don't think we have to worry about that for this fund, because the real estate portion is very small relative to the whole book. Okay, and then you've got currency exchange risk, which is changes in the relative values of individual currencies may adversely affect the value of investments and any related income. And then derivative counterparty risk. A counterparty to a derivative transaction may experience a breakdown in meeting its obligations, thereby leading to financial loss. I mean, you've got the clearinghouse for that, but okay. And then you've got liquidity risk. If the insufficient funds or buyers or sellers of particular instruments, bonds, the result may lead to delays in trading and being able to make settlements and or large fluctuations in value. This may lead to larger financial losses than expected. Okay, and then just a disclosure, the portfolio may adhere to its policy objective and there are no material changes to the fund of the portfolio during the quarter. Right, like I said, this is the Prescient Income Provider Fund. I'm not sure if A2 is institutional or me and you, so retail, but I know it's not B3, which is the staff one. But yeah, this is the Prescient Income Provider Fund. Please hit me up if you have any questions, any thoughts. Check out my other videos, like, share, subscribe. I want to do more content like this, but I need the engagement and I need the support, right? So let YouTube know if you like this. Let YouTube know if you hated it. Yeah, thank you. I'm out.